Volatility scares most beginner traders, but volatility is neither good or bad. It's simply just data. My name is James from Mastering the Markets, and today we'll be unpacking what volatility actually is and how do we go about spotting it. So the key question is, what is volatility? Essentially, volatility just boils down to price movement. So it's how quickly and how fast something actually moves. And what it is measuring the size of the swing. So when price action moves up or price action moves down, we're seeing how volatile that action is. Is it moving, 1% a day, or is it moving 5 to 10% of the day? If it's that latter range, 5 to 10% moves within the day, that's a rather volatile market. So we're in a period of high volatility. Now, what we're looking for is essentially, are we in a period of low volatility or high volatility? And we look at that by looking at the candle. So within a consolidation phase, that's typically low volatility. So price action is just slowly going up and down, and it's consolidating. It's not breaking any forms of ranges, and it's potentially not even trending the market. When we see a high volatility period, we're definitely trending either up or down. Volatility isn't a direction, it's how we measure price action. Why does volatility actually matter? Well, as traders, we like it as traders. Traders love volatility. We don't necessarily like uncertainty, right? And investors, they don't really care either way. But as traders, we need to know how volatile the market is, because we need to position ourselves accordingly. So volatility shapes how big our positions actually are and how much room we have to give our stop losses and our take profits. If it's a volatile market and we're seeing very big zigs and zags and they're occurring fairly frequently and the corrections are rather big, we need to account for that with our stop losses so we don't get stopped out. What causes these high volatility events is, think announcements within the market. So the Fed might be meeting, or some news event has just occurred. Now, typically as traders, we can trade that in our personal accounts, but if we start looking at things like prop firms, they won't actually allow us to trade during high volatility periods. So we do need to keep that in consideration. And, volatility isn't bad. It's just a condition of the market. It's as simple as that. It's part of it. Sometimes very volatile, other times very chill, not volatile, very low volatility. So that's the market, right? So what we're going to do is we're going to go dive into the charts, and we'll have a look at silver and a couple of different scenarios of volatility that's played out. All right, so this is silver, and it's currently on the weekly chart. And what we can see is we have a very nice resistance zone and a really nice support zone. And we can see that price action is very slowly drifting between these two very key levels, right? And this is a very long period of time. So this is between 2014 all the way over to 2020. So that's a 6-year period of price action not really doing anything. It's just drifting. It's ranging. It's a range bound between these two levels. That's a very low volatility market, isn't it? It's not really doing anything. It's just trending on sideways. And then all of a sudden, we get a little bit of a liquidity grab below the support level, and off it goes. Price action all of a sudden rockets up. And so between March 2020 to August 2020, we actually get a really decent size move, don't we? So if I measure that right now from our low all the way to our high, that's 155% move in 5 months? We didn't even get that over 6 years. So this, all of a sudden, we had a change in volatility, didn't we? All of a sudden, we got very quick move up to the upside. So there was a very high volatility period of time. 2020 is actually when COVID occurred. So we could start, assuming or thinking that the news event of COVID actually created a high volatility period of time for the market to move. Okay. And, silver and gold, they're precious metals. They're kind of correlated to safe haven. So it kind of starts to make sense, right? And then we can see that after the big move, we actually start trending sideways again. So from August 2020 to March 2024, another four years, another 4-year period, we're trending sideways again. So very low volatility. But then what do we have? If we zoom it all the way out, look at this. We finally broke the resistance level, had a nice break and retest. So we actually turned that previous resistance level into support, and then bang, off we went. So 4 years there, we were fairly range bound, not doing anything. And then all of a sudden, what did we get? We got a 334% move, and that was in 2 years. So we can see that when we actually get a high volatility period of time, it rockets, it moves. It doesn't take all that long to see those gains and that profit, does it? So what we're seeing is in high volatility periods of time, we get our biggest moves. So what we can see is that volatility isn't actually something to be scared of. Volatility is actually, as traders, where we make the most money. But we have to be smart about how we do it. We have to make sure that our stop losses are in correct positions. Okay, so we got to make sure that our stop loss is below our market structure, our pivot points under our high or low. And then if that high or low isn't taken, you're off to the races. So if you do get stopped out, you don't want to be in that trade anyway, because all of a sudden your market structure has changed. And that's something that we look at Mastering the Markets through our courses. You can follow all that on the Academy. So I hope this helped. I hope this has now explained what volatility actually is, and that volatility really isn't something to be scared of as traders. Volatility is kind of something to actually be embraced. Thank you so much for jumping on and watching this video, and we'll catch you on the next one. Bye.